The great scientist Isaac Newton lost almost all his savings during the stock market crash of 1720. He famously remarked, "I can calculate the motions of heavenly bodies, but not the madness of people." Why is it that the great bull markets in China's stock market often become financial graves for retail investors, and the fastest way for the middle class to slip back into poverty? In fact, much of the data related to China's stock market is publicly available. The Shanghai Stock Exchange publishes the Shanghai Stock Exchange Statistical Yearbook every year, but most people lack the time, determination, and ability to thoroughly study this data. Some may say the stock market is untouchable. Stock markets everywhere are just mechanisms for cutting leaks. 割韭菜, cutting leaks, is a metaphor for the upper class of powerful people oppressing and exploiting the lower class people. It is also a metaphor for people in a dominant position exploiting people in a disadvantaged position by taking advantage of information gaps or information asymmetry. But that's not the case. Let's look at two stock market comparison charts. The top chart shows the Dow Jones Industrial Index over the past 40 years, and the bottom one shows the Shanghai Stock Exchange Composite Index over the past 30 years. You'll notice that the U.S. stock market has a steady upward trend, only experiencing sharp declines during black swan events like the 2008 financial crisis or the 2020 COVID-19 pandemic, but it always recovers afterward. If we look at it over the long term, the U.S. stock market is consistently rising. Now look at the Shanghai Composite Index. It often spikes abruptly at certain times, followed by sharp drops, and has shown almost no significant growth over the decades. Each surge and crash in the Chinese stock market is accompanied by a massive redistribution of wealth. However, this redistribution of wealth does not transfer from the rich to the poor. On the contrary, every bull market makes the rich richer, the middle class poorer, and the poor even poorer. There are two main reasons for the extreme volatility in the Chinese stock market. First, China's stock market is policy-driven and does not follow basic market principles. It doesn't rise when the economic environment is good, and it doesn't necessarily fall when the economic environment is bad. For example, from 1992 to today, China's GDP grew from $427 billion to $18.5 trillion, a 43-fold increase, but the Shanghai Composite Index has barely changed. Another example, in 2020, the global economy slumped due to the pandemic, and China faced multiple lockdowns and production halts in 2022, but the A-shares didn't show significant declines. Thus, the stock market does not reflect China's economic conditions. Second, the larger reason for the volatility in China's stock market lies in the structure of its investors. In the U.S., 80% of the trading volume comes from professional institutions, while only 20% comes from retail investors. In China, the situation is the complete opposite. 82% of the trading volume comes from retail investors, and institutions account for only 18%. By the end of 2022, there were 46.38 million stockholding accounts in China's stock market, of which only 124,900 belong to institutions and enterprises, while 46.26 million were individual investors, accounting for 99.73%. Among these retail investors, about 90% have less than 1 million renminbi in capital, and as many as 23.05 million retail investors have less than 100,000 renminbi in capital. In other words, nearly half of the investors in China's stock market are small retail investors. As for the professional investors, meaning individuals with over 3 million renminbi in their accounts, there are fewer than 1.46 million, making up about 4% of all shareholders. The characteristics of small retail investors include small capital, lack of professional financial knowledge, poor risk tolerance, and a general desire for quick gains. This makes them overly sensitive to market fluctuations and prone to frequent trading. In comparison, U.S. retail investors trade on average 15 times per year, while Chinese retail investors trade as much as 60 times. Retail investors also tend to follow trends blindly. Every time there's a bull market or a favorable policy, a large number of retail investors rush into the market. For example, during the recent National Day holiday, brokers worked overtime to open accounts for individual investors, and since late September, the number of new accounts reached over 6 million, with younger investors born in the 1990s and 2000s being particularly eager, as they haven't yet experienced the hard lessons of China's stock market. As retail investors flood into the market, trading volume soars. On a typical day, the daily trading volume of A-shares is about 900 billion renminbi. But on the first trading day after the National Day holiday on October 8, the trading volume surpassed 1 trillion renminbi in just 20 minutes, and by 2 p.m., it had reached 3 trillion renminbi, setting a historical record. As a result, the herding effect among Chinese retail investors, buying aggressively when the market is rising and selling hastily when it's falling, leads to a very high turnover rate, further intensifying market volatility. However, despite contributing the vast majority of the trading volume, only a small proportion of retail investors make profits, and the amounts they earn are not significant. In years when the stock market overall is profitable, retail investors' gains are far lower than those of institutional investors. In loss-making years, retail investors' losses far exceed those of institutions. For example, in 2017, the total profit of the A-shares market was 3.4535 trillion renminbi, but retail investors only earned 310.8 billion renminbi, meaning the profit margin of institutions was 46 times that of retail investors. In loss-making years, retail investors suffer even greater losses. In 2016, institutional investors held market value of 14.34 trillion renminbi, while retail investors held 5.66 trillion renminbi. Although the institution's market value was 2.5 times that of retail investors' losses amounted to 72% of the institution's losses. In 2016, retail investors lost about 710 billion renminbi, while institutions lost 982 billion renminbi. The loss rate for retail investors, loss amount/market value, was 12.54%, more than twice that of institutions. The crazy bull market of 2015 is still fresh in the memories of many retail investors. That year, the stock market surged from July 2014, reaching a peak of 5,178 points on the Shanghai Composite Index on June 12, 2015. However, the subsequent stock market crash caused the market to collapse rapidly, dropping to 3,500 points within 2 months, and to 2,638 points within 6 months. I remember that year, everyone was talking about the stock market, even street cleaners were paying attention to it. One of my friends invested the money he had saved to buy a house for his wedding in the stock market, and many of my relatives and friends were also trading stocks. I thought everyone had gone crazy. And just recently, during the National Day holiday, the same scene replayed. In the past, I would advise people not to touch stocks, but now I choose to keep quiet because they think I'm blocking their path to wealth. In conclusion, the great bull markets in China's stock market are the main reason for ordinary people's wealth loss. Every crazy bull market is a process where wealth flows from the poor and middle class to the rich and the state. There is a saying that this bull market is the result of the state helping local governments reduce their debts. Do you remember the South Sea bubble incident in the UK? It was also a government-led debt-to-equity swap. Many people lost all their money, including the famous physicist Sir Isaac Newton, who also left with a loss. Can Chinese uncles and aunties be smarter than Newton? Therefore, as a retail investor, choosing not to enter the market might be the best way to protect your wealth. But then again, in a country where everything is controlled, it seems there aren't many good investment options available to you. I'm Lino, a Titan living in China, learning English. See you next time.